Hey there, investors! Welcome to another exciting journey into the world of passive income. Today we're talking about mortgage real estate investment trusts, a fascinating and often misunderstood segment of the real estate market. Mortgage REITs are a unique breed in the real estate investment trust world. They don't own physical properties like traditional REITs. Instead, mortgage real estate investment trusts deal in mortgages. They invest in mortgage-backed securities, which are essentially bundles of mortgages packaged and sold to investors. These securities are a way for investors to gain exposure to the real estate market without owning physical property. Got it? Good. Let's move on to how these mortgage REITs actually make money. The primary way mortgage REITs generate income is through the interest payments from the underlying mortgages in their mortgage-backed security portfolio. Think of it like lending money to someone and getting paid interest, but on a much larger scale and with a diversified pool of borrowers. This income stream is crucial because it allows mortgage REITs to pay out high dividends to their investors, which is a major attraction for many. But remember, investing in mortgage REITs is not like buying a rental property. You're not dealing with tenants or property taxes. Instead, you're investing in a company that manages a portfolio of mortgages, which can be a more hands-off approach. This can be appealing for those who want to invest in real estate without the hassle of property management. So, while it's a different ballgame compared to traditional real estate investing, it offers its own set of advantages and opportunities. Stay tuned as we dive deeper into the world of mortgage real estate investment trusts and explore how you can make the most of this unique investment opportunity. Now let's talk about why folks love mortgage REITs, passive income. These babies are known for their juicy dividend yields, often higher than your average stock. Why? Because real estate investment trusts, by law, must distribute at least 90% of their taxable income to shareholders as dividends. Think of it as a steady stream of cash flow, paid out regularly. That's the beauty of passive income. You earn while you sleep. For investors seeking a consistent income stream, mortgage REITs can be tempting. But hold your horses. Before you jump in head first, remember that high yields aren't everything. They come with risks, just like any other investment. Listen up, because this is important. Mortgage real estate investment trusts don't operate in a vacuum. They're heavily influenced by market trends, and understanding these forces is crucial. First up, interest rates. Interest rate fluctuations are like the weather for mortgage REITs, unpredictable and potentially stormy. When rates rise, their borrowing costs increase, potentially squeezing their profits. On the flip side, falling rates can be a tailwind, boosting returns. Next, inflation. This sneaky monster can erode the value of future income, impacting mortgage REITs' long-term profitability. And let's not forget housing demand. A healthy housing market keeps those mortgage payments flowing, while a downturn can spell trouble. Remember how we talked about interest rates being a wild card? Let's dig deeper. These companies often borrow short-term to finance their long-term investments. This strategy, known as leverage, can amplify returns, but also magnify losses. When short-term rates rise faster than long-term rates, it's like squeezing a lemon. Mortgage REITs' profit margins get squeezed too. This is called a flattening yield curve, and it can be a real downer for mortgage REIT investors. But hey, it's not all doom and gloom. When interest rates are favorable, mortgage real estate investment trusts can leverage their portfolios to generate outsized returns. It's a high-risk, high-reward game, folks. How do I navigate these risks? Now let's talk risk management. Understanding the risks involved in any investment is crucial for long-term success. It's not just about making money, it's about protecting your capital and ensuring sustainable growth. Investing in mortgage REITs isn't for the faint of heart. These investments can be highly volatile and require a keen understanding of market dynamics. They come with inherent risks, but fear not, there are ways to mitigate them. First up, prepayment risk. This occurs when borrowers pay off their mortgages early, which can disrupt the expected cash flow. Imagine lending money to someone, and they pay you back early. Sounds great, right? Not for mortgage REITs. Early repayments mean they have to reinvest at potentially lower rates, impacting their profitability. Then there's credit risk, the chance that borrowers default on their mortgages. This can lead to significant losses. The chance that borrowers default on their mortgages is a real concern. Defaults can lead to significant financial losses for mortgage REITs. And don't forget about interest rate and liquidity risks. Interest rate fluctuations can affect the value of these companies, while liquidity risk involves the difficulty of selling assets quickly without a loss. Diversifying your mortgage real estate investment trust holdings is key to spreading the risk. By investing in a variety of mortgage REITs, you can cushion the impact of any single investment's poor performance. Consider real estate investment trusts with different investment strategies and property types to cushion the blow. This way, you can create a balanced portfolio that can weather various market conditions. Okay, let's take a closer look. Alright, enough theory. Here are some real-world examples of mortgage REITs. These companies play a crucial role in the real estate market by providing liquidity and funding for residential and commercial properties. Understanding their performance and strategies can give us valuable insights into the broader economic landscape. We'll look at their dividend yields, stock performance, and risk management strategies. These factors are essential for investors to consider when evaluating the potential risks and rewards associated with mortgage REITs. By examining these elements, we can better understand how these companies navigate the complexities of the real estate market. First up, we have Redwood Trust, ticker RWT, focusing on residential and commercial mortgages. Redwood Trust has been a significant player in the mortgage REIT sector, known for its strategic investments and robust portfolio management. Their approach to balancing residential and commercial assets provides a diversified income stream. With a 9% dividend yield, it's tempting, but remember their negative total return in 2024. This highlights the importance of not just looking at high yields, but also considering the overall performance and market conditions that can impact returns. Next is Ready Capital, ticker RC, specializing in small balance commercial and SBA loans. Ready Capital's focus on small businesses and SBA loans makes it a unique player in the mortgage REIT space, catering to a niche market that can offer both opportunities and challenges. They boast a 10.7% dividend yield, but their 2024 performance was dismal, even reducing their dividend payout. This serves as a reminder that high yields can sometimes be a red flag, indicating underlying issues within the company or broader economic pressures. Now for the big fish, Annaly Capital, ticker NLY, the largest residential mortgage REIT. Annaly Capital's size and market presence make it a bellwether for the industry, often reflecting broader trends and shifts within the residential mortgage market. Their 13.4% dividend yield is mouthwatering, and their 2024 total return was positive. This combination of high yield and positive returns makes Annaly Capital an attractive option for many investors, though it's essential to stay vigilant about market changes. But remember, past performance doesn't guarantee future returns. It's crucial to continuously monitor these investments and stay informed about any potential risks or changes in the market that could impact future performance. AGNC Investment, ticker AGNC, another big player, focuses on agency residential MBS. AGNC's emphasis on agency-backed securities provides a level of security and stability, making it a popular choice among risk-averse investors. They offer a whopping 14.7% dividend yield and delivered solid returns in 2024. However, it's important to consider the potential for volatility, especially in a fluctuating interest rate environment. But remember, high yields often come with higher volatility. Investors need to weigh the potential for high returns against the risks of significant price swings and market instability. Lastly, New York Mortgage Trust, ticker NYMT, invests in various residential assets. Their diversified approach includes a mix of single-family homes, multifamily properties, and other residential investments, aiming to capture different segments of the housing market. They offer a 12.2% dividend yield, but their negative total return in 2024 raises concerns. This underscores the importance of thorough research and due diligence when investing in mortgage real estate investment trusts, as high yields can sometimes mask underlying issues. Which of these are the right fit for me? Now that you've met the contenders, let's compare their strengths and weaknesses. Remember, there's no one-size-fits-all answer. The best mortgage real estate investment trust for you depends on your risk tolerance, income needs, and investment goals. Annaly Capital and AGNC are giants with impressive dividend yields but also come with greater volatility. Redwood Trust and New York Mortgage Trust offer diversification but haven't delivered stellar returns recently. Ready Capital, while offering a high yield, has shown vulnerability to market fluctuations. Remember, this is just a snapshot. Thoroughly research each REIT, considering factors like portfolio composition, management team, and future outlook before making any decisions. Investing wisely requires careful consideration. Before you jump into the mortgage REIT pool, let's talk about essential investment considerations. First up, liquidity. How easy is it to buy or sell shares of a particular real estate investment trust? You don't want to be stuck with an investment you can't unload when needed. Next, consider the exchange mechanism. Are the real estate investment trusts you're eyeing traded on major exchanges like the NYSE or NASDAQ? This ensures greater transparency and liquidity compared to over-the-counter markets. Don't forget about risk. Thoroughly assess the risk factors associated with each real estate investment trust and your overall portfolio. Consider your risk tolerance and investment horizon. Your safety net in the REIT game? Let's talk diversification. Don't put all your eggs in one basket, especially in the volatile world of mortgage real estate investment trust. Spread your risk by investing in REITs with different property types, investment strategies, and geographic locations. Remember, diversification is your safety net. By diversifying your portfolio, you cushion the blow if one sector or REIT underperforms. Investing in mortgage REITs can be a wild ride, but with careful research, risk management, and a diversified approach, you can potentially reap the rewards of passive income and long-term growth. Before we go, there are few points I'd like to bring up about why now may be the time to invest in mortgage real estate trusts. Firstly, we have a new president and administration. President Trump has historically been a pro-business, low-interest rate advocate. He views these as major objectives toward our economic success and is likely to govern accordingly. And let's not forget that Donald Trump is a real estate investor. That was his primary business before, and he knows better than most what it takes to have a healthy real estate and mortgage market. Let's not forget about all of the efforts of Elon Musk and the Department of Government Efficiency, which is proactively cutting spending on a daily basis. How can this affect mortgage REITs? Less government expenditures means less borrowings. This could have the effect of lowering interest rates over time. Time will tell. If you found this material valuable, please like and subscribe to the channel. It's a big help. Thank you for watching. Until next time, good luck out there. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs. Consult with a financial professional if needed.